Good evening. This is Chapter 8, Cash and Internal Controls, Part 1. We're going to talk about all the different aspects of cash and the internal controls related to those to cash. So for internal control system, you need policies and procedures managers use to protect the assets and ensure reliable accounting. And why do you need that? You need to make sure that if you have cash that nobody's taking it, that shouldn't be. And you want to make sure that your accounting system allows for that. The Sarbanes-Oxley Act requires managers and auditors of public companies to document and certify the system of internal controls. Section 404 of SOX requires that managers document and assess the effectiveness of all internal control processes that can impact financial reporting. So this happened because of all of the issues that, we had with when people did audits and they didn't find all the issues that were happening in these public companies. Then Sarbanes-Oxley Act came into play. So all of these Sarbanes-Oxley things are relatively new and are just because of some of the things that have happened in the past. So principles of internal control are common to all companies. They establish responsibilities, they maintain adequate records, they ensure assets and bond key employees, separate record keeping from custody of assets, divide responsibilities for related transactions, apply technological controls, perform regular and independent reviews. With computers, it has made some of the internal controls a little bit harder and other internal controls quite easy. So technology and internal control work together to reduce the processing errors. So that means that you're not going to have as many manual errors as you had in the past because there's the checks and balances are there. They limited evidence of processing, so now the actual track of transactions, the audit track, is not there anymore. You used to be able to follow every single piece of paper through the system, and now we don't have the paper, so then you don't have as much evidence of that it actually got processed correctly. More intensive, so now make sure that we have all the possible controls we can. There's more intensive testing of those records to make sure they're done right. And it's very crucial that you separate the duties of the employees, and you have increased e-commerce with increased e-commerce. The separation of duties is, for example, the people who open the mail aren't the people who check in the mail, who aren't the people who check in the deposits, who aren't the people who write the checks. So that there's separation, so everybody has separate duties so that nothing gets commingled or can be taken advantage of. The limitations of internal control, the human error factor. There can be negligence, fatigue, misconduct or misjudgment, and confusion. We all know that we can get tired, and that can lead to misjudgment and confusion and maybe negligence. But fraud is you have the intent to defeat the internal controls for personal gain. So you have to, for there to be fraud, you have to have done it for personal gain. So that's a huge burden to prove. So human fraud is a triple threat. You have to have opportunity, pressure, and rationalization. So a lot of the fraud that we saw in the last 10, 15 years has been because someone had undue influence on on their person. So they were broke. They needed money. So then oh, wait a minute, here's some cash that came in. Now I have the opportunity, and they can rationalize it. Oh, well, they won't notice it. So they can, you see how there's that triple threat? The opportunity, the pressure, and the rationalization. Whenever you have that kind of pressure on yourself, you can do things that you wouldn't normally have done. The limitations of internal control. The costs of internal controls must not exceed their benefits. So you want to have good internal controls, but you don't want it at the point that it's going to be so costly to implement that it would far outweigh any of the benefits that it would do. Okay, now we're moving away from internal control to cash, although we will be talking about the internal controls of cash at the same time. So theoretically we're moving on, but not really. So the control of cash. The effective system of internal control that protects cash and cash equivalents should meet the three basic guidelines. Handling cash is separated from bookkeeping for cash. So handling cash, if you're actually getting the cash in your hands, is not going to be the same person who actually records the transactions in the general ledger. Cash disbursements are made by check, not by cash. Cash receipts are promptly deposited into a bank. Cash, cash equivalents, and liquidity. Cash and similar assets are called liquid assets because they can readily be used to settle such obligations. Cash is currency, coins, and amounts on deposit in bank accounts, checking accounts, and some savings accounts. Also includes items such as customer checks, cashier's checks, certified checks, and money orders. Cash equivalents are short-term, highly liquid investments that are readily convertible to a known cash amount, close at the maturity date, and not sensitive to interest rate charges. Cash management. The goals of cash management are twofold. You have to plan cash receipts to meet cash payments when due, keep a minimum level of cash necessary to operate. The effective cash management involves applying the following cash management principles: encourage collection of receivables, delay payment of liabilities, keep only necessary levels of assets, plan expenditures, invest excess cash. So whenever, I know in my niece's business, they're very slow in the summer. They don't get enough cash to make it through the whole summer, so she has to plan ahead to make sure that they have enough cash for the whole summer to pay themselves, to pay their employees, and to pay the rent and utilities for the whole summer. They're theoretically open, but they're not going to be getting the cash that they would get through the rest of the year. So for those 3 months of the year, their cash is way, way down, or the cash intake is way, way down. So they have to make sure they've planned for all of that stuff, and they may have to make some delay payments of liabilities just to make sure that they have enough cash. Over-the-counter cash receipts. This graphic illustrates that none of the people involved can make a mistake or divert cash without the difference being revealed. So your sales departments, so clerk rings up cash sales on register, clerk prepares cash count sheet and keeps copy and sends company cashier along with cash. The sales department has cash sheets. The cashier's department gets the same thing. They double check it. The supervisor reads register data, prepares register sheet and keeps copy and sends both to company cashier. So you see the supervisor does not have anything to do with how much cash was in the drawer or the credits. So, but they take and come up with how much should have been there. And the sales department, the cashier department, puts all the cash in, and then the two get matched to make sure that they agree. So the cashier prepares the cash records, the deposit slip, and the journal entry. Cash over or short. Sometimes errors in making change are discovered from differences between the cash in the cash register and the record of the amounts of cash receipts. If a cash register's record shows $550, but the count of cash in the register is $555, we would prepare the following journal entry. So now we're going to discuss the actual journal entry. So you're going to debit your cash, credit your sales, but the difference of how much cash we took in and how much our sales were, the difference is going to go into cash over or short. So that either means that someone got shorted when they gave out change or gave them too much and they didn't catch it. Cash receipts by mail. Preferably, two people are assigned to assign the task of opening the mail in the mailroom. The cashier deposits the money into the bank. The record keeper records the amounts received in the accounting records. Control of cash disbursements is especially important as most large thefts occur from payment of fictitious invoices. Keys to controlling cash disbursements requires all expenditures to be made by check. Limit access to checks except for those who have the authority to sign those checks. The voucher, there's a couple different ways you can run cash disbursements. You can do just going through a check register and the check register system, or you can go through the voucher system of control, which establishes procedures for verifying, approving, recording obligations for eventual cash disbursements, and issuing checks for payments of verified, approved, and recorded obligations. So what happens when a company gets an invoice or for something that they purchased? That means that the people in purchasing have to approve that, oh yes, we did purchase these items. Then the people in the stock department or the inventory department, they have to verify that we received the information, and then third, then it gets actually paid and approved for recording the obligation and for paying the bill. Kind of makes sense? I hope that does to you. So, the voucher system. So on the sender side, you request a voucher for purchasing and accounting. So then purchasing is a supplier requested and received in accounting. The suppliers are the vendors, and that goes to accounting. The receiving then sends a receiving report to the accounting, requesting and purchasing. So then you see how the different departments get affected. Then accounting approves it, or gets the approval, and then it goes to the cashier for payment. The cashier then writes the check and sends it to the supplier. So the whole process is requesting, purchasing, supplier, receiving, accounting, cashier, and then it finally gets sent out. It's kind of a long process, but it does prevent a lot of issues in the long run. Petty cash. Petty cash system of control. Small payments required in most companies for items such as postage, courier fees, repairs, and supplies. So typically you have a lockbox somewhere in somebody's possession somewhere, you know what, I'm gonna stop here because I'm gonna get over 15 minutes, and I can't post that then. Okay, I'll start petty cash on the next